Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. It's Thanksgiving this week. For those not familiar, Thanksgiving Day is an annual national holiday in the US and some other parts of the world, celebrating the harvest and other blessings of the past year. It appears financial markets are also soaking in a festive mood and offering something to be thankful for, as global equities and bonds extended their gains this week. No surprise that the main question from listeners had been whether this rally is going to last till the next festive period of Christmas. To discuss this and more, we are joined by Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. Hello, Manpreet. Let's dive right into the question. What are the conditions required for us to see a Christmas rally?
Hi, John. Thanks for having me on. You're right that US equities have indeed had a really great couple of weeks. But in our view, there are several conditions that need to come in place for this to extend right through to a Christmas rally. Now, the first thing we take a closer look at is technicals. If you look at the S&P 500 specifically, it does need to overcome a few key chart hurdles. And of course, similar sort of hurdles for US government bond yields and the US dollar. Now, the S&P 500 appears to face major resistance around the 4,600 level, from which it has retraced 4 times over the past 2 years. So, a sustained break of this level will most probably need further weakness in the US dollar, which in turn will probably require a decline in US government bond yields. But this may not be easy, of course, with the dollar index itself facing strong technical support around the 200-day moving average, and the 10-year facing some support around 4.35%. So a few different levels to keep a watch on over there. The second factor we pay attention to is positioning. Now, here we have less concerns. Now, US equities may look a little overbought in the near term, but momentum remains strong. Positioning also is less of a hurdle. Our fear and greed indicator is far from extreme levels that would raise concerns about a pullback, and we're not seeing concerns on broader positioning data either. In fact, we're of the view that there may still be plenty of firepower left to fuel the rally, especially among retail investors and mutual funds who haven't really participated in the month-long gains, which so far have really seen participation more so by quantitative funds. The third, of course, is a focus on fundamentals. Now, if we're talking about a need for a further decline rather, in the 10-year and the US dollar, we'll most likely need to be accompanied by modestly weak US data to avoid concerns of potentially higher rates, and or an improvement in European or Chinese data. Of course, if we get any more dovish turn in Fed commentary, that of course would be a support as well. So bringing all that together, we just believe that the conditions, particularly the technicals we discussed, do raise the chance that we face a period of consolidation in the couple of weeks ahead before the possibility of a Christmas rally becomes more viable. So as investors, our key takeaway would be that we look at this as an opportunity to rebalance, because this would not only help lock in some of the gains from the recent rally, but also ensure portfolios stay invested if conditions indeed come together for a Christmas rally later this year in both equity and bond markets.
Staying on equities, China appears to be rolling out more supportive policy. What does that mean for the China stock market?
You're right. I think we've seen a few interesting reports, from China, with media reports saying Chinese policymakers could target economic growth of 4.5 to 5.5% next year, and potentially roll out a package of financing support for 50 property developers to help backstop that industry. Now, such measures are in line with our own expectations that policy support should help stabilize economic growth in China. And I think, in addition, it's worth noting that in November, through the month of November, we have seen a weaker dollar, which of course is important because Chinese equities have historically outperformed global equities during periods of dollar weakness. I think from a market perspective, the one data point that really jumps out to us, though, is a very low investor positioning, because when you combine that with still pretty robust earnings expectations of around 15% earnings growth in 2024, we think this factor in particular could help Chinese equities at least recover in a gradual manner right through to the end of the year. Now, having said that, the point of caution we'd note is that investor sentiment does remain fragile. So, in our view, there's still that vulnerability to negative headlines. Geopolitical tensions remain one source of potential risk. Second potential risk, of course, is we get a rebound in the US dollar, given that relationship with Chinese equities. So, as investors, again, our preference to take a slightly more focused approach to Chinese equities, and we can do that via sectors that will benefit from growth in consumer spending. So, via preferred sectors, which are communication services and consumer discretionary.
You spoke about the rebound in dollar being a headwind for China equities. What about the CNH? Dollar CNH has been on a downtrend lately.
It has. But in our view, that decline in the US dollar CNH currency pair appears to be overdone. And we actually believe the pair may be set up for a rebound back towards the 7.3 level in the short term. Now, there are broadly three factors driving that view. I think first is our view on the dollar. As we discussed, a modest rebound there is possible given the fall in the sharp last few weeks. And from a fundamental standpoint, the one point I'd add is that we got the recent upside surprise in the University of Michigan inflation expectations number, and that, of course, could be one source of support for the dollar if we get more data illustrating that the decline in inflation could be slower than expected. Now, the second is that fundamentals themselves continue to point towards near-term CNH weakness, so a higher dollar CNH pair. Sentiment towards the economy, as we discussed, remains fragile, and if we get more fiscal and monetary policy measures, those, of course, could place downward pressure on the CNH. And third is from a purely technical standpoint, US dollar CNH does look quite oversold on the charts, and of course has rebounded higher from the 200-day moving average. So both fairly strong technical indicators that suggest a move higher may be likely. So what we'd keep a watch on is, near-term support, which of course we see near 7.116, but we believe the pair can rise fairly unimpeded until it runs into the next resistance around 7.265.
We also saw some huge move in gold and oil in recent weeks, a bit in opposite direction. Any important things our audience must take note of from there?
Yes, there were fairly significant moves. I think we're starting with gold. We had, of course, a rebound in the last 2 weeks, and we believe that was driven by the decline in real or net inflation yields and the dollar. But we are of the view that technical factors are not favorable for this move to extend. The first point here is that the tailwind from an unwinding of quite short positioning that's starting to fade as net positioning turns more neutral. Second is that we have the key psychological level of $2,000 an ounce. That continues to be a tough hurdle for the metal to cross. And third, on some technical indicators are now signaling gold is overbought, which itself can limit gains. So overall, on balance, we just expect a more range-bound outcome for gold, at least over the short term. Now, crude oil prices are a little bit different. Prices, of course, have been under some pressure, and we believe evidence of weak US demand may have been a key trigger. And that's evidenced in rising inventories in the US, at least since late September. Now, the other factor, of course, that's added to this is some uncertainty around the upcoming OPEC Plus meeting. I think markets, of course, expect some of the output cuts to either be extended or potentially deepened, but there's been uncertainty introduced with the delay of the meeting itself to the end of the month. Media reports of a disagreement on production levels. Now, for oil prices, we just think the next key data point to keep a close watch on is US EIA inventory data, because we start to see a turn in inventory and crude stockpiles here. That may very well provide the trigger for oil prices to start bottoming out in the short term.
We've discussed a lot. To wrap up, here's a few points to retain from this week's podcast. First, investors could consider rebalancing to help lock in some gains from the recent rally, while staying invested if conditions come together towards Christmas for renewed equity and bond gains. Second, we prefer to gain exposure in China via sectors that would benefit from growth in consumer spendings, and those are your communication services and consumer discretionary. Third, the recent decline in dollar CNH appears to be overdone, and last, gold is likely to trade range bound in near term. Thank you, Manpreet, and thank you to our listeners for listening in from start to finish. We truly hope that you enjoy the podcast. For those who are celebrating Thanksgiving, have a great gathering with family and friends this weekend. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.